Hey there, are you thinking about maybe remodeling your home, consolidating your debt, or do you have a large expense that's just around the corner and you're wondering how you're going to be paying for this? Well, a home equity loan may be a great option. No, I'm not talking about a home equity line of credit or a HELOC. I'm talking about a home equity loan, which is a little bit different. And by the end of this short video, you're going to have a full understanding of how a home equity loan works, and you'll be able to make the decision if it's right for you. Hey guys, I'm Chris Peach from 1AZ Credit Union and MoneyPeach.com, and I show people how to create a budget, how to save more money, and how to pay off debt. And in this video, we're going to be talking about home equity loans. So let's start off. What is a home equity loan? Well, it's really simple. A home equity loan is a one-time lump sum installment loan that you receive, and it's backed or guaranteed by the collateral or the equity in your home. Meaning, it's a loan that's guaranteed by your home, kind of like a second mortgage. Now, home equity loans are very popular because since they're guaranteed by the equity in your home, you often get a much better interest rate, much better than you would see with like a personal loan or a credit card. So with that said, how much can you actually borrow when it comes to a home equity loan? Well, lenders typically allow you to borrow between 75 and 90% of the available equity in your home. And that's based on a few things. That's based on your income, your employment history, your assets, liabilities, and of course, yes, your credit. So let's use a little example here. Let's say based on those factors, your lender says we'll give you 85% of the available equity in your home as a loan. So let's do the math here. Let's say you have a $400,000 home, but your current mortgage balance is $250,000. So if we use 85% of $400,000, we get $340,000. And if we subtract the $250,000 mortgage, we have a home equity loan for $90,000. Much more than like a credit card, right? So let's talk about interest rates. How does an interest rate work when it comes to a home equity loan? Well, the good news is interest rates are very competitive. Because you're using the equity as collateral for your loan, interest rates are lower, often just slightly above that of current mortgage rates, but much lower than a credit card rate and even lower than a personal loan. Interest rates are also fixed rate loans. Unlike a home equity line of credit that has a variable loan, interest rates with a home equity loan are fixed rate loans, meaning you can predict what you're going to pay every single month in a principal and interest payment. So for the life of the loan, which is usually anywhere between 5 and 30 years, you're going to have a fixed monthly payment. So what are some common reasons borrowers tend to use a home equity loan? Well, I will say the number one reason you see people using a home equity loan is to remodel or improve their home. And it makes sense. You're going to take the equity in your home to remodel or improve the home you're currently living in. And the IRS actually gives you a tax break. You see, the IRS states if you buy, build, or substantially improve your home, that is guaranteeing the loan, that you can deduct that interest on your taxes. Another reason borrowers tend to use a home equity loan is for debt consolidation. Maybe you're trying to get out of debt and you know it'd be much quicker if you could trade a high interest credit card rate for a low interest home equity loan. Now, that's a great idea, but keep in mind there is some risk involved because you're trading unsecured debt, meaning if you don't make the payment on unsecured debt, your credit could get dinged. On the other hand, if you don't make a payment on secured debt, like a home equity loan, your home could be in foreclosure. And lastly, we see people using home equity loans for large expenses. Maybe that could be college expenses, and often a home equity loan has a lower interest rate than a student loan. Or maybe that could be for wedding expenses. Yes, there are wedding loans out there, and a home equity loan tends to be much lower than that of a wedding loan. Okay, so when does a home equity loan not make sense? Well, I would never get a home equity loan to pay the monthly bills. The reason why is if you're having trouble paying your monthly bills, you're only going to exacerbate that problem in the form of a fixed monthly principal and interest home equity loan payment. So definitely don't do that. Another reason is for vacations. You never want to go into debt for any kind of entertainment or leisure activity. The worst vacation is the one you bring home with you in the form of payments. All right, lastly, here's some key takeaways that you need to know when it comes to a home equity loan. Remember, it's different from a home equity line of credit or a HELOC. A HELOC, you don't start making payments on that until you actually draw on that line of credit. A home equity loan, you start making the monthly fixed principal and interest payments right away and for the life of the loan. Also, make sure you can afford that second mortgage payment. Yes, a home equity loan is technically a second mortgage, so make sure you can afford both that primary mortgage and that home equity loan payment each month. And lastly, keep in mind a home equity loan is guaranteed by your home, meaning if you fail to make payments on your home equity loan, yes, your house could be in jeopardy of foreclosure. Alrighty guys, thank you so much for watching this video. And if you found this video helpful, do me a favor, hit the like button, comment, share this video. We want to help as many people as we can to make the best decisions with the everyday money. Alrighty guys, thank you so much for watching and we'll see you guys in the next video.